Today, folks, I'm going to share with you 5 recession-proof Canadian dividend stocks that have the utmost best performance. They're currently hitting all-time highs, and each one of these 5 are in completely different sectors. But one of my favorite sayings, first and foremost, is that bears sound smart, bulls make money. And we are heading into one of these market environments where I don't think being skittish is going to reward you in the next 24 to 48 months. The next 12 months are going to be rocky, but that's the buying opportunity that is currently presenting itself to you. And I don't want you to hide in your little room and conspiracize that the entire housing market's going to collapse. So let's just first and foremost talk about the sectors, what's going on in the market, especially the Canadian market here, because taking a look at a heat map over the last year, it's kind of incredible to think that we're starting to see a pullback on everything. That wicked oil energy rally we saw, we'll talk a little bit about that, is pulling back pretty dramatically. Banks are hitting 5-year lows. Taking a look, the railways have held up incredibly well. We're seeing a little bit of stocks in between here that have done pretty nice over the last year, but it's far and few in between when we're talking about the large caps. The last 30 days to see how bad the market is, and it is mostly red outside of tech. And Canada's tech sector only makes up 12% of the entire economy, which is very small, with things like Shopify, which definitely aren't hitting all-time highs right now, with an exception of a stock we're going to talk about at the end of this video, so stick around for that. But let's talk about the housing market first and foremost. For the first time, the housing market is starting to cool off a bit, but in the last month, we're actually seeing the value of homes sell for higher than they were at the beginning of the year, which is pretty incredible. Not all-time high value, but a little higher, even though volume sales are still down 20% year over year. And in my area specifically, homes that are selling anywhere from $500,000 to 1.2 are selling pretty quickly within a couple weeks. Anything in the $2 million range to $4 million, getting that luxury home areas, are in fact still selling. And one of the stocks here in Canada that's probably the most world renowned for Canadian real estate has got to be Canadian Apartment Properties, which yields right around 3%. And over the last year, it is starting to rally back from those October lows. It's still trading off its all-time high of about 21%. And this company has a double-edged sword kind of against it here, because obviously it's not a company in this rocky market environment that is doing a lot of acquisitions. They're doing some rehabs, fixing a lot of their properties up, and they kind of have this landlocked position, or landlord locked. I don't know what the exact term is, but it's controlled, right? It's rent controlled basically. So they can only raise rents roughly 2% a year, whatever the government mandates on a lot of their properties. If tenants turn over, they can bring new tenants in and increase the price to whatever the market demand is. And because market demand is so high right now, as they turn over clients, as they get new clients, they should begin to see or the revenues continue to go up. However, net income might get hit because of what we're seeing here with weighted average mortgage interest rates, of 2.6% is astounding, but their average weighted of maturity is 5.2 years. So in the next 5 years, all their mortgages are going to come up for renewal at the higher rate. And something tells me we ain't going back below 2%. So we're going to slowly see their cash flows or net income get eaten up slightly, but they'll probably see a bit of a balance with revenue growth, but that's going to lead to nominal growth, right? And we can already see that from their earnings. I mean, the revenue was up 5.8%, but we can take a look at the net operating income was only 0.7%, maybe because of write-offs, whatever. They are doing share buybacks, which is nice to see as well. Very few REITs do share buybacks, and their payout ratio is only 63%. So if you're looking for income stability, still growth in the long term, especially when interest rates start to come back down, over time this REIT should do just fine. Not exceptionally explosive like tech, but it's a good stabilizer if you want real estate exposure, right? But what's funny is, like many of the sectors we're going to talk about, it's very monopolistic here in Canada. And I love how they talk about the fact that we are the fastest growing population of all the G7 countries, including India. And that's because we're immigrating like 500,000 people a year, and we have the most expensive real estate market above the United States, Germany, United Kingdom, Japan, France, Italy. Canada is a very expensive place to live. I don't think that's going to change anytime soon. I honestly don't think the real estate market will crash that bad, but I'll pass that question off to you. Nonetheless, let's talk about the financial sector, because it's heavily reliant on the real estate market. With mortgages coming up for renewal, I'm sure there's going to be a fair percentage of people that can't afford them and are going to be forced to sell their homes. Royal Bank, all my favorite banks, they're coming up with earnings next week. So do not miss those, because they're the defining factor of the entire Canadian economy, as Royal Bank's Canada's largest company, and it is trading down a bit. So I honestly think so long as they stop putting loan loss provisions aside, it's going to be tumultuous for 12 months. But as soon as they stop putting loan loss provisions aside, their net income is going to jump dramatically. EPS will look great. and these stocks will probably continue to rebound to the upside a bit. And then once we get through the shock of this market, interest rates aren't going back to zero, and in a higher interest rated environment, banks make more money. I don't know why the likes of Warren Buffett are selling his banks when Michael Burry from The Big Short's buying banks, because I think this is where we buy. I think this is the opportunity. TD, I think, got unexceptionally hit because they didn't go through with the deal of Horizons in the US, which would have made them one of the top 10 largest banks in the US. So they got just hit unreasonably hard, and I think this is a big buying opportunity. BNS paying a 6% yield. It's sitting at a 5-year low. You take a look at something like Canadian Imperial Bank, also sitting at its 5-year low, both paying almost 6% yields. Not going to go wrong there. We'll come back next week and rehash the financial sector. But Enbridge, on the other hand, a dividend favorite amongst Canadians, paying a 7% yield, has now started to pull off its highs. And this has a lot to do with the oil market. If we take a look at the actual oil prices themselves, even with OPEC trying to cut back and, try and drive the price up, we're starting to see some pretty cyclical lows here. And I don't understand Buffett selling banks and buying oil and energy. I think oil is going to be around for a while, but it's so damn cyclical in nature that these companies, they really perform off that. But Enbridge, I believe, is the exception. I honestly think Enbridge is one of the better buying of energy stocks because it's a utility company. It's a utility to the energy space. They offer liquid pipelines, gas transmission and midstream, gas distribution and storage. They're a utility to natural gas through most of Ontario. If you walk out and see a natural gas line into a house, it's probably Enbridge. Their adjusted EBITDA went from 4.1 billion to 4.4. Most of their sectors grew. Liquid pipeline, gas transmission, gas distribution, all of these went up except for their exposure to renewable power generation, which is one of the smallest segments of their whole portfolio. So this is a company that when we compare it to some other oil stocks, for example, like we even talk about C&Q here, Canadian Natural Resources, a favorite of the bunch. Let's talk about how this one's being affected, because this one's actually holding up what looks to be much better over the last year to date here. It's actually up 9.36%. Having a hard time wrapping my head around that, because when we take a look at their actual earnings here, every aspect of their business is down. I mean, you take a look at crude, everything dropped off by a few $billion year over year. Their net income, if we take a look at the adjusted free cash flow went from 4.9 billion to 3.4, and the stock's managing to hold up pretty nicely. And I find it odd because these renewable stocks, even though I didn't think they were trading at wicked multiples, are getting hit a lot harder. I mean, they are. Let's use Northland Power here as an example, right? This is one of the first stocks I ever bought. I don't have exposure to it right now. Pays a monthly dividend. Right now it's at 4%. PE is very reasonable at 10. And from its peak right now, I mean, it's down 41%. Which is pretty astounding. I mean, a 41% decline. My God, guys, what is happening here? I mean, their revenues are down, net income. This company's highly debted. They do have a lot more liabilities than most utility companies. I mean, that could be one of the reasons their net income's going down. It's down a lot, 69%. Revenues are down. You're going to have to do a bit of deep diving. Maybe I'll make a specific video on this as well. But putting that aside, let's talk about 5 Canadian dividend stocks that are proving to be the utmost recession-proof. And I'm going to start with the boring one, in my opinion, because it's the one everyone talks about, of course. That is Fortis. Fortis, guys, it's a tried, true, very well managed company, unlike the likes of Algonquin Power and Utility. Not paying as high yield at 3.85%. Has been very steady. Eddie is up this year and is starting to pressure back toward its all-time highs. Better to buy on the discounted dips. It always goes through cyclical dips. I don't like buying it when it's pressuring all-time highs, but the dividend is insane. I mean, you go back, let's look at a 10-year here. 10 years ago it was paying 31 cents, today 57, pretty much doubling the dividend over the last 10 years. Beautiful stuff. Now, more intriguingly, Waste Connections. This is a necessity. It's not something that, it's not like Starbucks where people just want it. It's something that you're going to need. And the 5-year performance on this company is astounding. The yield not as high at 0.73%, but it is pressuring back toward its all-time high here. Waste Connections, guys, they've done a lot of share splits. 3-to-1, 3-for-2. I don't know what's going on here. So it's hard to get a 10-year time frame because, again, with the share splits in between. But from 19 cents to 26 cents, let's look after the last share split. From 12 cents to 26. It's a lot of growth from 2018, to say the least. 12 to 26, over doubling of the dividend in, 6-7 years is pretty astounding stuff. Hydro One, following in line with the utility of Fortis, but is a different utility company, because this one only focuses on transmission lines, and they offer generators, a few other aspects of their business, but primarily just transmission lines. And this is a government spinoff. The government of Canada owned this. They spun it out in 2015, went through some tumultuous times, would have been a great buying opportunity at the dips, and now is pretty much year to date pressuring and holding toward its all-time highs, paying a 3% yield. I don't really get this company. I think it's just because the government might be doing some kind of insider weird stuff, because their net income was down, probably again related to interest rates. Revenue was up slightly, nothing to deserve an all-time high in a PE of 23, in my opinion. But hey, it's proving to be recession proof, and since it's been public, from 21 cents a share to 30 cents, it's growing very nicely, in line to double its dividend, probably over a 10-15 year period. Now, Constellation Software, this one has been an outlier in the tech sector for Canada. This thing only paying a 0.2% yield. You cannot argue the 5-year return of 170%, outpacing everybody. I mean, we're outpacing Apple, Microsoft, Shopify, you name it, Tesla. This thing is beating it. I don't know how. I don't know why. With an 84 times multiple, people just seem to be in love with this company. Don't know if it's insider related. Earnings were pretty good. I mean, net profit margins dropped slightly, but revenue's up 30%, net income up 22%, diluted. This was from last year. I guess we're still waiting on, Q1 revenue even misses here, but we got some insight. This is from 2022, but they're saying here that Q1 revenue rises 36% to 1.9 billion. This company's growing. It's a growing beast, baby. And taking a look at its dividend, same deal. 10 years ago, 94 cents. Today, $1.35. But for the yield you're getting, I wouldn't be buying this for dividends. Finally, we should talk about Canadian Pacific Kansas City Limited, which I don't know if they changed the name because this is Canadian Pacific Railway. 5-year performance up 131%. Again, not much of a dividend, but we're talking about a growth beast, a staple to the Canadian economy when it comes to the railways. A Warren Buffett favorite, for a matter of fact, from 0.07 cents 10 years ago to today at 0.19. That is some pretty extensive dividend growth. But again, that would barely put you maybe closer to 1.5% if you were lucky. But these 5 Canadian stocks have been crushing the overall market, and I think the real opportunity still resides in things like financials. Energy's debatable. I get that exposure through VDY. I think it's a great monthly paying Canadian dividend ETF. That's the ticker VDY. Check it out if you've never heard of it. It's a great way to cost average into a lot of these companies that I love. But I'll pass that question off to you. I love to know what you're buying and what you think in that comment section below.